All right. Well, hello, everyone. Hey, thank y'all so much for joining today. This is ACG Austin San Antonio's second panel discussion regarding CPG. In case you haven't met me yet, my name is Tyler Davis. I'm the Vice President of ACG Austin San Antonio Membership Committee. Last week, ACG hosted a panel of 3 of Austin's top CPG CEOs that was moderated by Wilkin of HireBetter. That discussion provided great insight on the new CPG landscape and how CPG companies are pivoting to succeed. A recording of that conversation is stored on the ACG website under News and Trends. I definitely recommend checking it out. There was a lot of great nuggets in there. 2 things to mention before we get started. First, if you're not an ACG member and would like to find out more about why you should become a member, please reach out to myself, to Sarah Singer, or Dylan Zwick, who leads the ACG Next Gen group. One reason to join ACG now is that June 23rd through 25th, ACG Global will host its first ever ACG Member Summit that will gather ACG's worldwide community of over 15,000 members. This is an event worth checking out. It's got an impressive array of speakers and networking and peer engagement opportunities, but you do need to be an ACG member to attend. And then second, I would like to thank our annual chapter sponsors. At the diamond level, we have Weaver, Insperity, and Dykema. And I see that we've got several of those representatives on call right now. And then at the platinum level, we have HireBetter. So thank you all for your support and partnership. We appreciate all that you do and support the ACG Austin San Antonio chapter. Quick housekeeping item, you have been automatically muted, but please submit questions for our panelists. And at the end of the event, around 1 or so, we will have a networking breakout rooms up until from 1 to 1:30 or so. So, all right, let's start this event. As I mentioned, this is the second panel discussion discussing all things CPG. Today's event is titled "The Future of CPG Investing," and it's with a Rockstar lineup of CPG investors. Introducing and moderating the CPG panel is Wilkin. Kurt has a unique perspective in the CPG space. He is the CEO of HireBetter, which is a strategic talent partner for many CPG companies. He's a longtime mentor in SKU. He's Austin's CPG incubator program. Kurt is also the founder of BCaves Capital, which invests in many CPG companies. And in short, Kurt is passionate about all things CPG. So to get started, Kurt, I'll let you introduce our illustrious panelists.
Awesome. Tyler, thank you so much for the introduction, and I appreciate the kind words. You know, I'm very glad to be here today, and I'm proud to be hosting 3 of the best people in the Austin community when it comes to CPG investing. So, and I want to also thank ACG for really providing a venue for us to have this type of conversation. You know, our goal this afternoon is simply to have a conversation, let you inside the minds of 3 very different types of investors, and really judging by the quality and quantity of the questions that came to me over the last week, I think we're going to have a great discussion. We're going to provide some real stories from real deals, and we'll address many of the common questions that we're getting these days from types of folks who are asking those questions. You know, what's it like to raise capital in a post-COVID environment or current COVID environment? What will it look like moving forward? We're not really going to focus too much on the COVID story. We'd like to not focus too much on the COVID story, but it's hard to address 2020 without talking about it. I've got a couple of things that are hot off the press that I wanted to make sure I got out there before we got to the panelists. First and foremost, you'll notice that we've got Kurt Wilkin, Chris Shonk, and Scott Collier right now on the call. We don't have Brother Alum yet, and that's because he is finalizing a deal as we speak. And I told him that people on this call would very much understand because we're deal makers ourselves, but he should be joining us within the next couple of minutes. And unfortunately, he won't be able to disclose too much information about that deal, but he'll be coming on. And then secondly, this is another hot off the press. It's not CPG related, but it is absolutely Austin related. This morning, a transaction was closed between a local company called Open Lending, which is a tech company. They just basically did an IPO through a backwards way called SPAC, a Special Purpose Acquisition Corp. Just closed it today. They're officially trading. Valuation over $1 billion. So we have another Austin unicorn that you guys should all be very proud of. So congratulations to anybody you're associated with Open Lending if you're on the call today. All right. So let's get to our panelists. First of all, gentlemen, thank you very much for being here. I know you've got super busy schedules, so thank you for taking the time out. Next up, what I'd like to do is I'm going to introduce each of you, and I'll tell a little bit about your background, but then I'm going to tee you up with a question about 2020. That way we can learn a little bit about what's going on in your world, and you can share with us some of the challenges that you faced when it comes to investing in a pandemic. So let's start with Chris Shonk. Chris is a founder and managing partner at ATX Venture Partners. He and I have been in some of the same deals together, but it took this event for us to meet for the first time. So Chris, great to meet you. Chris is going to be coming at us with mainly an angel investing in a venture capital perspective. And I'll tell you why that means, why that's meaningful here in the next few minutes. Chris has had numerous exits as both a founder and as an investor. He's been doing this for over 15 years in the consumer and the tech and services space. He's on the board of many companies, including SourceDay, Pensa Systems, and Slingshot Aerospace, among others. And one of the interesting tidbits I found about Chris is that he started his first business when he was 14 years old, and he was named Special Ops Soldier of the Year. So pretty cool stuff, Chris. And he is a graduate of the Acton School of Business and was the first alumnus to start an endowment to offer deserving entrepreneurs the opportunity to change the world. So Chris, thank you for joining us. Looks like Brother just joined us. So Brother, we just started, everybody's got to start with their most embarrassing story. So you tell us what your most embarrassing story is.
Oh man, maybe I had a rat tail in middle school.
That's my favorite line. That doesn't get old. Tyler knows that. All right. So next up, I'll introduce Scott Collier. He's been my friend for many years. He's a VP at Whole Foods Market, where his team oversees the Whole Foods local producer loan program, and they structure equity investments with partnerships and some partnerships with suppliers and operating partners of Whole Foods. Scott is also managing director at Rock Room Ventures, and he's got over 25 years experience, including Capital Southwest and Triton Ventures, as well as corporate dev roles at places like Vignette. Scott has an aerospace engineering undergrad from Texas A&M, and he's got an MBA from UT's Macomb School. So all of you guys are way more educated than I am, so it's always fun to introduce you guys. Then last but not least, Brother, I was telling him you were closing a deal, and hopefully you got it officially signed and done. I know you can't tell us too much about the deal, but let me introduce you, and then we'll go into next steps. So Brother is a senior vice president at CAVU Ventures, and he's got over 10 years of private equity investing in mostly growth equity and middle market transactions, mostly in the consumer sector. And at CAVU, he leads investments and serves as a board advisor for companies like Vital Proteins, Waterloo Sparkling Water, High Brew Coffee, Nulo Pet Food, and Johnny O's Apparel, among others. Prior to CAVU, he was a VP at Bespoke Capital Partners, which is also in the PE space for consumer goods. And he earned a bachelor's with distinction from Emory University, and it has an MBA from Kellogg, the Northwestern Business School. So thank you all for joining me. So before we go on, I'd like to remind everybody, please use the chat feature in Zoom to ask questions. We're going to do our best to get to all of them as we go. All right, enough of the fun that stuff. Now let's get into the meat. So let's lead in with the first question. I'll start with you, Brother. And I'd like for you to answer this question. Tell me, when you came into 2020, you had a vision for what the year was going to look like. We're sitting here June 10th. Obviously, it looks much different than the way I'm sure you imagined it. Walk us through your 2020 thus far.
It's been interesting. I think we started the year with our strategic priorities as a firm, which we just raised our third fund, which is a $250 million fund at the end of last year. So, we had a vision around starting to deploy capital with the new fund, but also we've been pretty actively focused on monetizations within our portfolio. So that's where the strategic priorities kind of started the year. And then, we quickly had to adjust to the environment starting in March when COVID came in. And, those continue to remain priorities, but we started to focus a lot more internally in terms of supporting our existing investments. The majority of the companies in our portfolio are, high growth, branded, top line revenue driven businesses that, are skating pretty close to profitability, but a lot of them are unprofitable. So, going through the lens and approach of how do we shore up liquidity across our portfolio. Fortunately, the majority of our existing investments are in the food and beverage space. So, it's not like a fitness club where all your customers just walked out the door for the next 2 months. Brands like Waterloo Sparkling Water have really benefited from the current environment because it's a pantry staple. But then there's others where customers are more sensitive, right? So, what I've found is working with the executives who run our companies, it's kind of pulled me into roles and spaces I never thought I'd be in as an investor. Things like, how do you communicate to employees within the COVID environment? Not only, through Zoom, but we found an increasingly number of our CEOs are spending time on, what are the health benefits plans, and what if an employee comes down with COVID, and much more active communication. And then, just in terms of continuing to direct the strategic plan for those existing investments throughout the rest of the year, but also, to my point earlier, shoring up liquidity. I think around the priorities that we started the year with from a transaction standpoint, those still remain in place. I think the current environment has created more opportunistic situations in terms of deploying capital, and got us thinking more broadly around, how do we invest into what could, what will eventually be a normalized environment. So, areas that are specifically benefiting from, digital traction that's occurred over the last couple of months. We're certainly focused a lot more on businesses or assets that are capitalizing on that, and beyond food and beverage. I mean, even more broader into fitness and personal care and apparel and other categories that people shop on online. So it's certainly kind of taken its twists and turns. I feel like we've reacted well the last couple of months, and hopefully have some line of sight to, a pretty solid second half of the year.
I think those are going to be some themes we'll see as we go through this. You hit on some good ones. How about you, Chris? If we again, getting that crystal ball out, what do you look like? What was 2020 going to look like? And now, we're sitting here June 10th. What's it look like?
Yeah, we do a lot of supply chain, kind of inventory visibility type stuff on the CPG side, sort of the tech side of CPG. So that stuff took off like crazy because empty shelves and retail visibility for supply chain had never been hotter. So there was an absolute wind in the sail for some of the tech investments we have. Across my CPG portfolio, generally I'm investing in more craft up and coming brands. Other than a couple, I mean, Waterloo was mentioned, some of these consumer staple type stuff. That stuff got put by the wayside because people weren't able to walk aisles and actually turn over cans and read the back, right? So there was this bulk buying effect that went in to all the category captains, really sort of at the demise of some of the younger, more juvenile brands, because people weren't really perusing the aisles and turning things around, right? So I did see a little bit of that in my angel portfolio. But as far as the year ahead, I mean, what I am excited about is that I think what happened with COVID just accelerated what was already a Darwinian change that needed to happen. There was already kind of early adopters for remote working and people trying to really get better visibility and use tech as a tool. That was sort of thrust upon society at large, both on the consumer side and enterprise side. And everyone's trying to do more with less right now and do it with a more remote and enabled workforce. So that's kind of the area we're playing in, and we're kind of doubling down on some of those theses because it definitely is resonating. I think it actually was good. I think it really did force an evolutionary step function to what was already starting to happen that just really, is now happening.
And I hope you guys are taking copious notes on the call. That's some good stuff there. I appreciate that perspective, Chris. Scott, how about you? Same question.
Yeah. So Wow, Whole Foods is the tale of two cities. It's the best of times and worst of times. You know, a lot of people consider Whole Foods just a grocery store, but big chunk of our business is, of course, prepared foods and meals ready to eat and eating away from home kind of things. And whether it's an office worker coming in for a quick lunch at the salad bar, or you know, somebody buying dinner while they're shopping for groceries, I think it's a lot of that business has gone away or changed dramatically. And so, you know, within the business development team, I think we saw literally two ends of a barbell, where anything that was packaged and grocery, and especially things that, you know, had a longer shelf life or in the freezer, we couldn't keep them in stock. And our portfolio of those kinds of companies did very well. Caveated with some faced supply chain challenges and some faced working capital challenges. You know, as an entrepreneur, you love to see a steep growth curve, but boy, that can cause a working capital crunch if you haven't planned for it, especially if you have to build a lot of inventory and you've got stuff sitting in warehouses and not making it through the supply chain to shelves. And then I think, you know, on the prepared foods, and, you know, keeping in mind that over 50% of the food consumed in the United States is away from home and prepared foods and restaurants, and that side of, you know, the U.S. economy has been decimated, right? So and given that we invest in any area really that Whole Foods is active in, you know, we've got investments in store-in-store sort of restaurant partners. We got investments in suppliers that have products on shelf. We have investments in technology partners, supply chain partners, et cetera. So, you know, I think where we saw those companies struggle and then some pivot really well was better embracing of delivery mechanisms, shifting to whatever they could package. You know, so relevant to this audience where we're focused on CPG conversations, I think the P is looming large as I think about how things have changed for going forward 2020. You know, packaging and how you deliver a food product, restaurants, food service in general has had a big now challenge. And even internally at Whole Foods, we talk a lot about how do we now reopen and re-engage with customers, given that a lot of Whole Foods differentiation as a retailer and a grocery store was around in-store experience. And I think as part of that, you know, what we're seeing is brands struggling with now, how do I get discovered, right? I mean, Whole Foods with a 500+ store footprint in many markets that's how customers in the food and beverage sector anyway, and to some degree body care and supplements, Whole Foods is where they discover new brands, new products, new categories, and experiment. And then they may go to other channels for sustained purchasing or may not. But that whole discovery piece has changed. So I think brands have to think about going forward. I think we're certainly talking about for our portfolio and our partner companies, how do we further assist in that discovery process? And then the other big change for this year is how people are getting groceries and food. Obviously, we've seen a huge uptick for anybody who's tried to order a Prime Now delivery on Amazon Prime Now delivery from Whole Foods, you know, the wait times and the challenges in getting a full cart. So we've seen a huge uptick on that side. So just considering how much is this going to be sustained, and are people in a new mode of buying, and will they use that mode for discovery, and what is that new status quo?
Well, that's all stuff we can, we'll definitely dive into. I made a couple of notes here that I want to ask follow-ups for. When we talk about the you know, investing in consumer packaged goods, as well as, you know, the impact on valuations. You know, Brother talked about really making sure that we retrench and our existing portfolio is taken care of. Scott, you just mentioned, you know, being packaged, being a good move. And then I'd like to ask, you know, start with Chris. I'd like to go around the table. What are you guys seeing as far as valuations, and what is your, how are you doubling down on consumer goods here in the, for the next 12 months?
Well, valuations, I think, you know, for the companies that were doing well, that didn't have a flush balance sheet, you know, as the pendulum swings more to the investor side in this area, you can kind of do a top off or an extension round, which is effectively buying at last round's terms. And usually the founders recognize the opportunity set they're in, and they want to resource up a little bit. So that allows you to move faster, gets them money faster so they can maneuver and execute, and allows us to get in at at pricing that we like. I haven't seen it with, companies that have traction. There've been much pushback on valuation. I've started to tease with participating preferred on some of these conversations as a go-between, right? Because the founders are going to want to try and, amplify valuation. We want to sort of get a deal, right? I mean, effectively participating preferred is just 1x more, right? But as long as you're optimistic and everybody's rah, 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 you're going to convert to common anyway. So that's been a good go-between to where I can give the founders, the valuation they want from a dilution perspective, but still be able to pad our returns a little bit. So that's really all I've seen. But the stuff that the companies I saw raising that either were really not there from a KPI perspective or suffered some kind of a hiccup in the past couple quarters, I mean, that stuff is just still nuclear winter. I mean, if they're raising any money at all, it's just super aggressive terms and, not really the kind of stuff you want to start a relationship out with. So we just pretty much passed on it.
I can see that. Scott, you want to answer the same question, or you can pass if you'd like?
Yeah, I think just adding on to that, I mean, we're getting close to closing a deal that's a participating preferred for exactly that reason. I think, we're sensitive to valuation, but we're also looking at absolute return in an uncertain future. So that's a good way to do it. That's a great tip. I think too, on the prepared food side and restaurant side, I think there's a pause. If we've got one company out raising, and we're not hearing so much no as we got to see what the future holds. So anybody that's in one of these vulnerable areas, while it may not be the door completely shut to investors, I think you're just going to have to find a way to make it through to a better funding cycle where there's more clarity.
That's a great point. Brother, I've got the same question for you, but before I do, I just want to stop for a second, take a deep breath, and acknowledge you just closed a freaking deal, and you were up, I think you said you were up all night working on it. Thank you for being here. Let me say that again, all right?
No worries, man.
We want to hear all about the deal, but I know you can't tell us the details, but let's answer that same question first, and then anything you could share about your deal, we'd love to hear.
Yeah, it's interesting. I think to both Chris and Scott's points a little, even kind of taking a broader perspective, right? We're in the middle of the worst pandemic in 100 years. We're in the middle of, the worst social unrest in 60 years. We're in the middle of the worst economy since the Great Depression. Yet the financial markets have gotten back to their pre-COVID levels and higher, right? So there's kind of a weird disconnect that I haven't exactly figured out. And I'm not a big public market investor, but I think that trickles down to how companies are continuing to think about their private market valuations. To Chris's point a little bit. So, at some point, looking out, you'd think the rubber would meet the road a little bit. But it isn't exactly there right now. So you got to solve, creatively through structures like the participating preferred, or, we've even explored, we haven't been looking at a whole lot of new investments, but, performance-based incentive grants that if a company hits certain top line and bottom line milestones, will claw the founders or the team back in terms of equity. So I think that'll continue to be a bit of a theme, but it'll evolve depending on how kind of the financial markets ebb and flow, and if this disconnect actually gets corrected at some point. On the CPG side, it's interesting because our general theme as a firm is we invest in businesses that make you feel better. So think healthy food or beverage product that sells at Whole Foods, or personal care product that sells at Sephora. And those broad macro trends towards health and wellness aren't going away, COVID or no COVID, but where it really impacts the businesses is how does it reflect in your channel strategy? So obviously, the retail door distribution expansion strategy becomes a little more problematic and tricky to work through if you're not getting new authorizations, or, foot traffic is down in stores. So a lot of our focus is what's the underpinning in terms of channel strategy for any particular brand we're looking at, and what does that look like at least over the next 6 to 12 months and even longer, if we can, get some sort of perspective on it in terms of how that influences, the financial profile of the business. And there can be offsets, kind of like I mentioned earlier. You may have, a significant decline in your retail channel, but if you got a robust and well-tuned digital channel, either your own or through Amazon, that can offset part of that, right? But you also don't know what's coming down the pike, even as we get to a new normal. Several retail, you look at GNC and they can kind of withstand the storm, right? At some point, the liquidity does become an issue, even as you go back to whatever the normal is, and as customers start to go back to stores. So we'll continue to look at CPG. I think we'll be even more kind of laser focused, or tunnel vision on how the channel strategy is going to influence the strategic plan going forward, and we'll continue to be opportunistic on the investment side.
We've seen a lot of companies be successful through their digital strategies. To your point, they're shifting most of their investment there, and it's been powerful. And even companies that are just starting out, maybe they can start building the brand themselves through those digital channels in Amazon versus going to the retail store first. We got a couple of questions that came through on the chat box. Let me, Brian, I'll get to yours, especially for Scott, but let me get to Issy first. They say, any perspective on the trend of manufacturers going direct to consumer and bypassing retail? We basically just talked about that a little bit, or I asked a question. What are you guys seeing? And I'll just raise your hand if you have a comment. Chris?
So yeah, we've got a manufacturing tech investment down in Houston called Macrofab. So there's like Fictive, there's some other companies out there that are really trying to near shore a lot of the supply chain, get manufacturing closer to the end user. And there's definitely a kind of a revitalization of North American manufacturing. I think the only problem is with that whole thesis in general is that's really cute until scale, right? So, manufacturing by definition is a step function sort of business, right? And it sounds great to have a facility where you can, order, do fulfillment, get that straight to a customer, everybody wins in classic business. The reality is we're all trying to invest in rocket ship brands that will eventually outstrip that capacity at some point. So then what's phase 2 and phase 3? That would be my only sort of look out for suggestion.
Good. Scott or Brother, any thoughts?
Yeah, I think just given that we're talking, what we deal in is food, beverage, body care products, supplements. So a lot of things that if you can't see it, touch it, read the ingredients label, look at other things on the shelf next to it. I mean, there's such an experiential element to discovery of innovative products and categories that while I think smart companies are building a multi-channel strategy for sure. And I don't think it's necessarily a bad strategy to go DTC first. I mean, we're seeing brands that launch at Whole Foods that already have a significant DTC component to their business, but they still want that retail customer because it can be a very different customer. Demographics are different, mode of shopping is different, and ability to switch brands is different. So, and there's instant price comparison you can do sitting right there. So I think there's merits to it, but it's about customer acquisition costs too. When you look at what's your margin on stuff at retail versus your DTC and what's your customer acquisition cost, I think there's factors to trade off there. So I kind of like the omni-channel approach, maybe for self-serving and obvious reasons, but I think it's continuing to pay off for those who can manage it.
Well, I appreciate that. I appreciate the comment too. You've got both Amazon and Whole Foods. You've got the omni-channel. There's a follow-up. It's a different question, but on a similar note from Chris. How involved do you guys get in coaching and helping your portfolio companies get traction with direct to consumer, getting on shelves, and then ultimately sales velocity once you're on shelves?
So good question. I mean, generally we're already investing in something that has traction. So we're just there to amplify traction. So we're not taking a stab in the dark at some thesis, like gluten intolerance or whatever. I mean, like there's already something that we believe in from a data-driven perspective, and we're out actively searching for brands that can ride that wave. I mean, one thing about CPG is timing is so mission critical. I mean, like the most important thing probably is right time for the category. You know, you want to be early, but not too early. You definitely don't want to be late to the party after it's a slugfest. And so once they're there on a shelf, we can really lean into that. So I would say we don't catalyze traction, we accelerate it once it's there. We typically invest post-revenue, post-product, right? I would say in this market right now, any of my new CPG investments, so we closed one actually last month, a company called Canteen, sort of, you know, Deep Eddy vodka, then Waterloo, so flavored vodka, flavored sparkling water, flavored sparkling water vodka, right? Like kind of natural progression, right? But the team is all veterans, right? So I'm not taking operator risk at this point, just because when you're in choppy waters, I found that veteran operators absolutely execute both on mitigating risk, but also on recognizing and capitalizing opportunities. So just to be frank, anybody that's a rookie, I'm putting into the, you know, happy to do a virtual coffee, you know, make an intro, help you on your journey. I don't have time for that right now for newbie operators, unfortunately.
Good feedback. Brother or Scott, any other comments on that direct to consumer velocity question?
Yeah, I think, well, I thought it was a coaching question, right?
Yeah.
Yeah. You know, we're minority investors, so inherently we're not trying to grab the wheel of the business. I think that Chris's point, we're somewhat along for the ride, but I think to the coaching point, the reason, well, let me say it's on a case-by-case basis a little bit as well, because to Chris's point too, every entrepreneur is coming from a different background and has different experiences driving a business. Sometimes you're working with a first-time CEO founders. Other times you're investing into a business where, you know, they've had a team that's had several reps at it. But I think what we really try and do on the coaching side is one, given we're minority investors and really along for the ride, making sure the company is adequately capitalized and the capital structure doesn't get screwed up so they can make the play. Because the last thing you want is a situation where, you know, a business is running out of cash in a couple of months, or they've gotten so upside down on their valuation, it's just putting undue stress on what the strategy is. So I think we try and be active advisors on that front, and that can play into the channel part as well in terms of how do you capitalize the business and what's the runway from a direct to consumer standpoint. As you know, Scott mentioned, the cost to acquire customer there is a lot different than going the retail channel. And then second, which I think is unique to our firm, you know, we have some bells and whistles around branding and marketing and strategic relationships with retailers and celebrity endorsements that we help bring in to help amplify brands. So, you know, our most successful investment up to today was a company called Bai, which is a low calorie beverage drink that, you know, we brought Justin Timberlake into and to help amplify the brand before Keurig Dr. Pepper came in and bought it. So we have a few of those kind of bells and whistles. We like to think ourselves as strategic value add, but I think those are probably the two anchors in terms of how we help influence the outcome.
Well, the question is, part of it is, you know, getting on and off shelves. And so obviously, Scott, you're in a unique position being an investor and you have a lot of shelves. So let me ask you this question that came in the chat, and we can relate it to what we just talked about. That is, to Scott, can you talk about some pros and cons of launching a shelf-stable condiment with Whole Foods in a few regions, such as Southwest and Rocky Mountain, versus launching with Whole Foods Global in early 21?
Yeah, and I think my response would be the same in most categories, not just condiment, shelf-stable condiment. I think I think entrepreneurs a lot of times focus on number of doors and how quickly can I get in lots of doors. And what I like about the approach of going regional and staying focused is build velocity and prove which of your SKUs and what's your differentiator, what's really going to work, and what's going to work against the competitive set, the replacement set, what gets customers' attention and fired up. And if you try to do that on a global basis and spread yourself too thin and fail early, you may never get a second chance. So I think the smart thing, and this is an environment where nobody's going to blame you for slow growth, and you're going to have some challenges with quick growth if you're just coming out of the chute. And so if you try to do a global strategy, well, we talk about global at Whole Foods, it's really a national strategy. If you try to do that and get in all regions of Whole Foods, it's going to be tough, and you're going to have to kind of ride the rising tide with a category that's maybe exploding, and there's a net gap that the merchandising team really wants to fill. But I think this goes to the other question about how we coach companies. You know, when I look at things like our loan portfolio, which is ballpark 100 companies, many very small suppliers in that portfolio, and whether it's that or the bigger end where we're doing equity investments and those kinds of partnerships, what we try to do is really focus the conversation on the relevant business team, which is usually the merchandising team. They're the ones making the on-shelf decisions, and they're often giving a ton of coaching to brands. I think that's one of the values of being on shelf at retail is, you know, DTC, you kind of put your best foot forward and hope for the best online experience. When you're working with a merchandising team, the Whole Foods merchandising team really has a lot of coaching experience they can share with you. Some brands are open to it, others are not. So I would say, you know, answering this question as well as looking at, you know, what kind of coaching guidance are you going to get from Whole Foods if we're an investor, it's really going to focus on those conversations and how much a brand is listening to the guidance they're getting from the merchandising or store and store partner.
Yep. Well, I appreciate that. Let me get to, there's a couple of questions in the chat. I think this question I had that came in earlier in the week is going to address some of it. And I'll just say that, you know, at HireBetter, obviously it's in the people business. At Bee Cave Capital, I tend to invest in people, in the founders. And so, Chris, you earlier said that right now you're betting on horses who have already had successful races. But let me ask all of you, from your perspective, what builds credibility in a founder and what it might erode it?
I mean, I can go on that. So I like people. I mean, it's really a four-way matrix if you think about it, right? So it's founder with entrepreneurial exit, and bootstrapping is different than taking outside money, right? So, you know, a lot of us have bootstrap companies. I did that once. It's different. I'm in the give you institutional money business. So I want to find a founder that's actually taken institutional money, navigated boardrooms, led a team, solved problems, and then taken that to a kind of a waterfall of liquidity for, you know, employees, investors, and themselves, right? So it's just a different animal than the bootstrapper. So I'm looking for, you know, if you kind of have this four-way matrix, right? It's founders with a venture-backed exits, you know, founders that have exited, you know, in that vertical, you know, that's the best place to be. Then there's people from the vertical, you know, senior, you know, CXO, senior vice president, somebody who knows the space, but has never been an entrepreneur, never taken money, never done something organically. You know, that's powerful, but not as powerful as venture-backed founder from space. Then there's, you know, where you kind of don't want to be, which is didn't come from the space, never taken institutional capital, never had any kind of success in that arena. That stuff, I send that to the angel networks or wherever. That's really kind of how I look at it, because there's so much opportunity. You know, the best thing you can do is just give a fast no to a founder, make an intro and say, catch you on the back nine. If you're successful, they'll remember it and you can be in their next deal. And that's happened a couple of times. But the worst thing to do is to spend time and let, you know, maybe the idea of false hope sort of, you know, emerge out there when investor and operator start to talk. You know, I think it's better just to be, you know, this isn't a fit. Here's why. Here's one or two people that might be able to help you on your journey and sort of float them on down the river, you know?
I like that. Get to know fast. Scott or Brother, anything to add there?
Yeah, I mean, for us, maybe we think about things a little differently, and sometimes it can create a bit of a rocky road, but I think we start with, you know, brand, product, you know, competitive differentiation, financial profile, category. And and whoever the founder is, you know, sometimes everyone's a product of their past experiences. I think increasingly over time, regardless of if they've been in the industry or been part of a venture-backed company, we really try and understand what makes them tick. You know, understand if there's a real path to a partnership there, where if we end up, you know, marrying together, taking our investment, we'll be viewed as a partner, and our thoughts and our advice will be, you know, incorporated into the long-term vision of the business. And we're even pretty proactive about that. I think early on in a diligence process, or at least in the middle of it, we've brought in executive coaches to, you know, figure out how do we resolve conflicts that come up as we work together. But, you know, I think some of the elements that I've found in our best founders, and quite frankly, as it's resulted in our best investments, is one, open-mindedness. One of our CAVU founders, Clayton Christopher, always says, a learner, not a knower. And vice versa on our end. We're not operators, we're investors. So someone with a good ability to exchange ideas, number one. Number two, for the particular asset, is someone who can get oriented to strategic thinking. So they're not knee deep in one functional area and that's all they do, whether it's sales or operations or marketing, but can take a broader perspective on a business and an unmet need that business is filling and how you capitalize on it. And then three, and again, we're investors at the end of the day, is just what's the financial strategy. I think sometimes a rub we've had with some of our founders is, you know, rate of growth at all costs. Even if it's at the expense of profitability, and markets and economic conditions change, which dictate how you think through the financial strategy. So someone who's kind of aligned on a path forward there, and how we, you know, ebb and flow as things change. The hard things we've had with some founders is just getting into the hype machine a little too much, and you can see it at the front end in terms of, you know, outsized projections that don't have a lot of kind of reasonableness and defensibility behind them when you kind of dig into the details. Too narrow a product, or too narrow an industry the product is addressing, and the ability to be flexible about how to think beyond that. And then a lot of it is just, you know, with any investment firm that a founder is going to partner with, it's about a personality fit as much as anything else. So I think those are some of the do's and don'ts for us.
Awesome. We've been seeing that we've gone from a B2C and B2B environment to an H to H, human to human, and you just talked about it there with the founder, and obviously we're addressing that with our customers as well. Scott, anything to add there before we move on to the next question?
I'd emphasize the learner versus knower. I think that's what we a lot look for. And of course, being a strategic investor around Whole Foods activity, we're often turning to our merchandising team to gauge what do they think of this supplier. Before we make any investment decisions, we only want to be investing in companies that they like working with, because going to the strategic point Butter's making, I mean, it's like, okay, here are your products today, but you have a well thought out roadmap. Are you an innovator? Are you listening? Are you coachable? Not to a fault. I think, you know, it's good to have a point of view and some firm ideas of what's going to succeed for your brand. But at the same time, are you paying attention to what you're hearing as it's being shared by a retail partner that has a lot of experience and looks across the category for success? So it's that coachability, and are they a thoughtful, well-rounded partner?
Awesome. I've got a question that Tyler's had here in the chat for a bit, and we're touching on it a little bit. So maybe we can just make this a speed round, and that is, what are the top fundraising mistakes and missteps that you're seeing companies doing? And just quickly around the horn, any quick thoughts? I'll start with you, Chris.
Yeah, I think when founders come in and they offer you terms, you know, like, we're raising around, here's what's going on, here's what we need, and that And that's just a bad place to start, because you're not saying, hey, there's an opportunity, there's a need, let's come together and think about this. You're literally commoditizing the complete relationship from the very first meeting and taking away the discussion conversation. I think that's just a novice move.
I like it. Scott or brother?
Yeah, I would say for us, it's, is it a fit for Whole Foods? We have a strategy, and coming in and telling us their strategy and not really sussing out what is our approach. If you come in and you're going to be successful not based on Whole Foods, or that's not really your focus, we have a point of view. We think, we want to be investing in companies that are going to be successful at Whole Foods, and that will lead to success in other channels. So I think it's listening to what is the investor's interest and focus.
That's a great point. How about you, brother?
Yeah, I think to Chris's point a little bit, there's a signal if someone's coming in and, kind of just throwing terms at you without getting into the business. The signal is your advice may not be as valued, which may be fine. They're businesses that you can invest in and just ride the hot hand, right? And we've certainly done that, but it doesn't necessarily build into the philosophy of how we like to invest. I think the starting point for us on any investment is, let's have a discussion about the business. And one, do we like the business, and do we like the opportunity? And then sequentially, if we do, how do we think about, valuation, capital raised, capital needed in the future, and how do we kind of like work backwards on what the end goal is in terms of monetization and set us up for success. I mean, more off the cuff and more blatant, I guess, is a consistent theme I've seen in the last few years, and it may change with the COVID environment, is companies that are raising money that either undercapitalized, don't raise enough, or gun the valuation. And that's fine too. I mean, everyone can have different views on valuation. That's kind of the beauty of investing, is different people have different points of views. But we tend to veer more towards entrepreneurs, founders, CEOs that really kind of have a data-driven value approach, that we can all look at the same objective set of information and come to an agreement on. And I think those are the ones we typically go more active with in terms of pursuing investment opportunities.
You got a round of applause for Chris, so he must agree with your perspective there. Hey, let me attempt to ask this question from Sherry in the chat box. So listen closely. Do you see that coaching from accelerators and mentorship also surrounds you with skilled advisors to build credibility before approaching large capital? And can informational interviews help? So I think, so it's around accelerators. Obviously, Sherry's the founder of SKU, so maybe some things around that. Any thoughts?
Yeah, so you and I are both mentors in SKU, and I send deal flow that way for sure, because that's what they do all day long, right? I mean, there's something about laser focused and the nuance and sort of opportunity set around that. And, so it's the relationships, it's how many patterns you see, it's what you can do and how you're helpful. So absolutely, I try to only make intros that are, kind of marketplace balanced, right? So founder that would appreciate accelerator that's going to appreciate founder, because, everybody wants to waste time. But I think it's actually very smart.
Awesome. Scott, you were going to say something?
Yeah, we're huge fans of companies having more sources of smart people around the table, because we try to stay very focused in our lane. We're a relatively small team. We've got a lot of, you look at 100 loans, 20-ish equity investments, a couple hundred store-in-store partnerships, all based on revenue sharing. I mean, there's a lot of touch points. And so the more we're working with companies that are supported by other advisors, especially around business areas that are not focused on the natural products retail channel, which is where, we try to stay focused with our expertise. We really rely on those sources of other, knowledge around the table.
Awesome. A quick shout out to SKU and Sherry, thanks for being on. Obviously they are the top accelerator in town when it comes to CPG, and any of you on the call with ACG and you're not familiar, take a look at it. There's some great opportunities for mentorship and investments over there. So good stuff. Let me ask a question here that came in earlier in the week, and that is, I'm a big fan of using, not really using, but through this COVID chaos, we're all trying to survive. Well, what can we do to go on the offensive and come out of this stronger? So my question is, what are some of the things that you guys are seeing that some of your portfolio companies or maybe even your own firms are doing to pivot or to really to do whatever it takes to come out of this stronger than before? Raise your hand if you'd like to address it.
Sure, I can go ahead if you want. So one thing I think that's really been a boon for my personal angel investments and some of the stuff that we're doing that's in traditional CPG, like the consumer packaged goods, is we're data people. So we're technology data venture capitalists. And so we have a company called Pensa Systems, right? And they have real-time visibility to what's on the shelf, what's in the store, and where it is on store. Big deal, because there's Instacart now, there's phantom inventory. This is a very big operational task. And all the CPG brands are effectively slave to the retailer from the supply chain perspective, right? Like there's no Pop-Tarts coming until someone knows they need Pop-Tarts. And this environment has changed that all. Now, what's great about that is that the co-investors that I get to talk to and work with are AB InBev, General Mills, Procter & Gamble, Johnson & Johnson, right? So everyone right now is leaning into database decisions, not only about how to, what products to put on shelves, but how to price them. How is marketing responding to that price? What's sales velocity? Where's the trend? It's all about being proactive and saying, hey, look, there's some of this moving, there's none of this moving. Maybe a new product actually is deserving shelf space there. And where is this product? So it actually goes back into the entrepreneurial side. So it's given us the ability to have sort of an unfair demand side of things. Plus we're e-com tech people, and a lot of brands are starting digitally before they go brick and mortar. And so that's just also another piece of data that, you didn't have before. So I think to wrap it up, I'm really using unfair advantages in consumer sentiment and demand and or pricing or shelf positioning by a demographic in a certain store in a location to make better informed, larger bets on some of my early bets.
So let me just tell everybody out there, Chris is a data guy. I'm a people person. So if we're in the same deal, you better double down on that deal. Hey, Scott, how about you? You look like you were going to say something.
Yeah, I think, and I was just on a board call this morning on this. What I've been impressed with is some of the companies in our portfolio doing the pivot and doing a smart pivot to say, what's our plant foot, right? What foot are we going to hold in place? Where's our core competency? But how are we going to swivel to address market gaps? And so in the face of people's interest in, sanitation, protective gear, immunity, health, wellness, all the things, right? And so I think it's doing both. It's not just not having a direction and just going after flavor of the month, but it's more, what I've been impressed with is some companies really doing a smart pivot and staying grounded in their core products, but also rapidly bringing to market things that maybe deliver better in the current environment of delivery or meet a need state where there's a net shortage going on. Now, the caveat to that is what are they planning for in the long term? And are they ready for a potential leveling out or a big competitive mix? And so, it's thinking that quickly and being willing to pivot when you're faced with this kind of a challenge that's impressed me.
Nice. Brother, I've got one more question, but if you want to add anything to this, please do.
Yeah, I'd reiterate everything that Chris and Scott said. The data-driven part that Chris mentioned, I think, is also it's important also because when things are going well, as an investor, and if you got a portfolio, you just kind of let the business go as it goes. But when you're dealing with a little more times like we are now, where it's a little more challenging, you want it to be data driven, just so you can kind of set the guardrails on how you manage the business. And I think being data driven is a good way to do that. The additional point I'll add to what Scott and Chris said is all the CEOs and founders I work with are it's all unforeseen circumstances right now, right? There's an interesting article about wartime versus peacetime CEOs, and how it sometimes can be a bit of a different lens in terms of how you approach your business as a result. And, the CEOs I work with are, if there's a pie chart of their time and 95% of it was running the business, that's probably come down now because of the unforeseen circumstances, right? Now there's 15% where one of my CEOs spent an inordinate amount of time last week on what kind of press do we put, not press, but how do we address social unrest? And do we need to put some sort of announcement out there around that? And it can be very damaging if you go about it the wrong way, right? But at the same time, you have to be empathetic and aware of what's going on in the world. So a lot of what I'm telling my CEOs is, you're going to be distracted by things you probably weren't distracted with 6 months ago. So you got to figure out how to resource that. Or, they're great advisors that probably wouldn't fit in my skill set that could help you with some of that stuff as well, right? It's kind of a new world and new challenges that they have to deal with.
Well, that's one of the. That's actually my last question is there anything else that you'd like to add? And I'll say, is there any piece of advice that you would give to some of these CPG companies as they're going out there trying to raise capital? And I'll close the remarks. Who wants to go first? Scott, you want to go first?
Yeah, I mean, I think we know a lot now about resiliency and what it's going to take to be resilient in a pretty challenging series of environments. So I think there's good news in that if you're surviving today and you've kept the tires on the car, there's a race to be won. In terms of raising capital, I think the markets are holding, and so I'm seeing deals continuing to get done. Obviously, Butters did one, so I think we're still looking at new deals. So I think it's just stay focused, have answers to the question that's going to come up inevitably. How are you going to respond to future crises like these? And use your experience to prove that you've got a resilient business. If you are facing something if you don't feel like you have a resilient business, you better build components that allow you to survive through this kind of a challenge. And we're certainly seeing, more restaurant-oriented fresh food companies having to do that. So what is your packaged goods strategy and your delivery strategy to get around these kind of challenging times and come out the other end?
Thank you, Scott. Chris or Butler?
Yeah, sure. I'll go. Great point. One of those was actually what I was going to say, so it's a little bit flat-footed on that. But I would absolutely say that, two things. One is what is your unfair advantage, right? This is CPG we're talking about. It is a war of attrition. It's very fundamental: manufacture, distribute, cost, price, et cetera, right? So very fundamental business principles here. But you can have an unfair advantage on customer acquisition via online channels, different things like that. So how do you acquire customers cheaper? How's that edge? Unfair advantage in deal structure. So working capital is the curse and of all these CPG companies, is you can actually grow yourself into a tricky spot, right? So how do you have fantastic unfair advantage terms with your co-packer, basically accounts payable and receivable, right? Like, can you solve that riddle and bring those closer together? I mean, perfect thing is kind of like this, right? Like Dell did. But if you solve that, it solves a bunch of other problems and lets you move 100x faster by not having these giant goalposts of time between payables and receivables. And I think the third thing would be successful businesses need money. And, solving the access to low cost of capital ahead of your needs for capital allows you to find that gas pedal and push it when the data tells you it's time to push it. And if you can solve one of those three, if not all three ahead of time, and I think last is kind of to your point earlier about talent and people and Butler as well, alignment, so that's all great. You've got an unfair advantage. If you're going to go take the hill, if you're going to go in that direction, are your investors on board? Is your executive team on board, and is your junior staff on board? And then ultimately your partners, right? Is you did a deal with Whole Foods, you have a deal with is everybody aligned in what the goal is? Because these are choppy water environments and things are moving fast, and misalignment actually trips up the whole organization. So I would just say those couple things.
Awesome. Buther, 30 seconds. What's your final thoughts, parting thoughts for us?
Yeah, I mean, on that point, unless you're in a crisis situation, you know, keep in mind what the long-term goal is for the business. It shouldn't change unless your business is changing. And, you know, it's about taking a deep breath and making sure strategically and capital-wise, you're still working towards that long-term goal, whatever it is, taking the business public, you know, getting it to cash flow positive where it's funding itself, selling it to a strategic, but, you know, no kind of rash decisions because of COVID. We have a quote internally: you build a business to be bought, not to be sold. Right. And so keeping that in mind in terms of whatever authenticity and whatever the long-term goals are in the business, and not losing sight of that.
I love that quote. Hey, there's a couple of questions that are in the chat. Sarah, I'm going to ask you to please help us save that, and I'll work with Tyler to get those questions answered afterwards. I want to say thanks to Mark Nathan for sending a link to Peacetime and CEO, Wartime CEO article from Anderson Horowitz. Hey, I'd like to again thank ACG for putting this together. Really appreciate you guys doing this, and thank you again to Buther, Scott, and Chris. Appreciate you taking the time to do this. You guys are doing great work. Keep up the good work. And to all of you, thank you for joining us. I'm going to turn the mic back over to Tyler Davis. He's going to talk to you about next steps with a virtual networking for the ACG folks. And panelists, if you want to stick around, we could throw you into a networking group where you can have a smaller group conversation. So Tyler, take it away.